all with the higher oil prices, except for the fact when you hear Republicans talk about worries about inflation and what inflation that can come out in gasoline prices. And of course, that is so tightly linked to the price of WTI or Brent. But it would be interesting to see what the response is from this administration in terms of what is going on in Europe. I did recently speak to Amos Hochstein, which is a senior advisor on energy security, and he was warning Europe that they need to start making sure that they have enough gas to last through the winter. And if it's a cold winter, he'd even said it could be risking lives. Is America starting to worry now about the energy crisis that we are seeing take place transatlantically? We should also note that we do have the National Security Advisor, Jake Sullivan, on a trip to the Gulf. He's in Riyadh. He's meeting with the Crown Prince of Saudi Arabia. He's also going to the UAE. This would be a time for them to discuss energy prices if they want the price to come down. This would be a time to make that ask to pump more.
Anne-Marie, thank you. Down in D.C., our Washington correspondent. A little bit of news on Evergrande coming from Reuters, Tom. China asking state-backed firms to buy Evergrande assets. So this is the Chinese Communist Party asking state-backed firms to buy Evergrande assets. That news this morning, Tom, coming from Reuters.
You've got a bond out there 4 years out, John. You've shown the chart many times. It's your standing data check. I should know your outstanding standing data check.
Thank you, Tom. That means a lot.
How about those 61.6% Evergrande bonds? You need to pick up a few of those today.
Deeply distressed. We don't know what happened with that interest payment from last week, Tom.
25 on the dollar.
We've got another one coming on Wednesday. 25 cents on the dollar.
Yeah, that's
deeply
the price,
distressed.
and the yield equivalent is 62%.
Got to work this out, Lisa. There's a lot to work out.
Is this a backdoor bailout?
It's a bargain.
That's my question, right? It's basically saying to state-owned firms, you better buy this stuff, a way for China to bail out Evergrande without risking the moral hazard. And I do wonder if that's what people are looking for right now in some of the crisis management techniques that the Chinese regulators are engaged with throughout China.
State back, not the exactly sort of back door, is it? It's pretty obvious. They're doing it through the front door.
Sure, although, you know, you could say that they're more selective, they give them a haircut. I mean, yes, you're right, this is a front door bailout, but how do they then deal with...
The government.
All right, fine, fair, you got it right. But there is a question of how they message this then, while continuing with saying that they are definitely going to allow companies to fail.
We're going to have a slowdown. Goldman came out with a forecast for GDP growth in China, Tom, for this quarter. It was 0. And Nomura's looking for something worse, I think. So they're looking for a slowdown broadly.
Yeah, those benchmarks, you know, the old style here is under 6% is not good for China. And what's important, John, and Dr. Alarian once really emphasizes to me, you've got a global GDP growth under 3%, bad things happen.
Yep. Catching up with Mohammed on Friday. Looking forward to that. It's been too long.
A different property.
On the Open.
He won't get up for me. He says he won't come on until the Jets win.
It's funny, when you took a day off, he came on once.
I know.
I don't know what that's about.
I do.
Might have to figure that out, Tom. Tom Keane, Lisa Bravis, Jonathan Ferro. Your equity market down 43 on the S&P. We're a little bit softer here. We're negative about 1 full percentage point. Near session lows, Tom, with yields higher. Let's call it 5 basis points to 153.
Yeah. Tots Aston Villa. We could sit next to Governor King.
Looking forward to that. Tom. Are you excited about that game?
Let's call it 5
You're
basis
not
points.
looking forward to PSG Man City a little bit later this afternoon?
Yeah, we're going to race home and watch that.
Up for that.
I got a lunch I got to go to. I'm going to McDonald's for lunch, and then I'll race home to PSG.
Are you, Tom?
Yeah.
3 p.m. Eastern time for that game. For those of you interested, futures down 43. We're negative 1% from New York City this morning. Good morning. This is Bloomberg.
can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Watch Bloomberg Surveillance to stay on top of the latest market trends, commodity trends, and fashion trends.
Are you going out for a fitting on a base suit?
I'm going to go and get a base suit. The crowdfund was very profitable.
$100,000.
Came in at about 100K, which is what it would take for me to wear that suit on this network. How do you get that bulky fit? I'll find out. I'll have a chat.
You get bulky,
get the
John.
bulky one.
You know, on a channel in the president.
Look at those markets.
Don't taper the pants. They're
John,
going to
you
futures
look
down
so
6.
good in a base
We're
suit.
net on the
dreaming.
S&P. What a change in a week. Last week we were talking about a China growth scare. A week later we're talking about the return of the cyclical trade. You see that in the equity market. We're negative 0.9% on the S&P, but it's relative outperformance I want to talk about. It's in the small caps. The Russell negative 0.4%. The Nasdaq down by 1.66%. And yesterday, 2 percentage points plus of outperformance on the small caps. We'll keep digging into that. Tom, what's changed? Crude's changed in a big way. Switch on the board and get to the energy story. This is what it looks like. Brent pushing 80 through 80 a little bit earlier on. WTI 76 up 0.9%. Energy equities absolutely flying. And Tom, in a moment, we'll catch up with Francisco Blanch of Bank of America. TK, that call's amazing. Triple-digit crude by next summer and maybe on a cold winter, perhaps sooner.
It is. It's very important here, and let's get right to this right now. I mean, this is so important. We're going to do individual stocks here, John, and then we've just got to talk to Francisco about the dynamics of oil.
Looking forward to catching up with him. What's changed? 20 basis points, that's the change. Switch up the board and get to the bond market. It's a 20 basis point move from where we were just last Tuesday. This Tuesday morning, we are at 154, 153 on 10s, up by 4 basis points. On 5s, we're through 1%. That's the rate hike dance right there. The front end through to the belly. 2s, 31 basis points. It's that price shaping the narrative, not the narrative shaping the price. It's always the price change that shapes the narrative. That's your cross-asset price action. 10s at 153.39. Let's get you some movers and say good morning to Romain. Morning, Romain.
Hey, good morning, John. Everything you just talked about, that's a big part of the narrative of what we're seeing in the pre-market today. It was a big part of the narrative of what we saw yesterday. Of course, an embrace of those short-duration cyclicals and a little bit of a shunning of some of those long-duration mega-tech companies. You're seeing all of those names lower here in the pre-market: Apple, Amazon, Facebook, Twitter, and Microsoft. We should point out Microsoft, which is down about 1.7% here in the pre-market, had actually been one of the more resilient members here of that big cap tech space. But yesterday, it really broke down. It closed below its 50-day moving average for the first time going back to June here. Also keep an eye on Applied Materials and some of the chip stocks. They're getting dragged down in this as well. There's also, though, some negative commentary out by New Street Research and a few other sell-side analysts saying that some of those chip equipment makers may actually be at their cycle peaks. Flip up the board here. One of the bright spots yesterday is one of the bright spots here in the pre-market, and that's Ford. The share is absolutely on fire, up about 3.3% here in the pre-market, setting up for a 5th straight day of gains, opening 4 new factories here in the U.S., including an assembly plant, its first assembly plant in the United States, built by Ford since 1969, and 3 battery plants, a huge bet here on an EV future that, of course, has to do with scaling up battery production and getting those costs down. And then, of course, the flip side of that, of course, is the old way of powering things. That's with oil. Oil stocks up once again here in the pre-market, as you noted, John. Brent crude at 80, WTI at 76.
Romain Bostic, thank you so much. Greatly appreciated this morning. Watching oil, and of course, into the close, we'll have a full cross-asset update as well. Right now, Francisco Blanche of Bank of America, Global Commodities and Derivatives Research Head. We at Bloomberg want to bring you all we can on hydrocarbons. Francine Lacroix earlier this morning with Jeffrey Curry, and now at $100 a barrel, Francisco Blanche. Francisco, I want to channel the research of Caldera, Cavallo, and Iacoviello at the Fed in their landmark piece 5 years ago on the elasticities of oil. Adam Szymanski talked about this years ago at Deutsche Bank. How tight is the oil market so that when demand shifts, the price explodes?
Well, there's different ways to look at this, but generally, we for every million barrel a day swing in supply or demand, unexpected, we look at typically about a $20 move in prices. And again, there's many ways you can run this calculation, but think about it: 1% move in demand or supply, unexpected, leads to a $20 price move. That's the issue here, and we are probably seeing more extreme moves in natural gas, because of the reduction of that price elasticity. That linkage between gas and coal is now leading to even sharper moves on that front. So clearly hydrocarbons are in a tight spot from a supply and demand elasticity, from the response of both supply and demand to rising prices.
John, you know the rule of thumb, don't mention elasticity on air, it confuses people, but that's the heart of the matter right now. It's the ugly math of elasticities, and we're seeing it to $100.
TK, let's not bury the lead. Let's go straight to that forecast at Bank of America. It's $100 crude, triple-digit crude, Francisco, by the middle of next year. Now, help us understand the path to 100, and help us understand why you think we might get there sooner.
Well, so the path to 100 is basically being driven by tightening supply-demand conditions. We are seeing demand coming back. It's coming back from a mobility standpoint, but it's also coming back with natural gas prices rising so fast and creating substitution back into oil. And that's at the heart of the matter. The heart of the matter is that we're going to be over the 2019 demand levels sometime next summer, or maybe this winter if the weather turns particularly cold. So we are concerned about that because we have a lot less capacity. Remember, shale oil production is way lower than it was back at the peak of the cycle in shale in early 2020, and frankly, we've seen severe underinvestment in the last 18 months. And I'm not sure that underinvestment can be easily corrected, because now we're moving into a green economy. And guess what? I mean, if your time horizon is 3, 4, 5 years to recover your money, you just need a higher price. And I think a lot of companies are reluctant to make the investment because of what they're hearing from governments and investors.
And this is so important. Typically, Francisco, we would say the cure for higher prices is higher prices. Jeff Curry of Goldman, a peer of yours, this morning speaking to Francine Lacroix, saying this is the revenge of the old economy. It's the underinvestment that you describe of the last several years that is starting to bite. And I think what you're getting at here is really important. Francisco, how long we might have to live with this? Could this be years of this?
It could potentially, and we are moving into, I mean, the thing is, remember, we are moving into a straight jacket here for energy. We don't want to use coal. We want to use less and less gas. We want to move away from oil. So this policy ultimately is going to create deeper and deeper underinvestment. And the issue is we can't sort out all these things at once. And if the weather turns against us, and it has so far this year, we've had low hydro in China, we've had low wind in Europe. Now, if we have a cold winter on top of it, things are going to get complicated because we are depending more and more on renewable sources. And we don't have the industrial scale batteries required to store that energy throughout the year. So I think that's where the challenge is, in my view. So yes, it could be a multi-year period until we finally transition to a green economy where things are calmer.
Francisco, this backdrop is bullish for oil prices, and we've already blown through some of your forecasts for September when it comes to Brent. I mean, how much are you bringing forward the idea of triple-digit oil prices?
Right. So we've been saying it was going to be a summer 2022 when global air traffic recovered. And remember, at the end of the day, the biggest gap in global demand has come from the airline industry. We've shut down most of airline travel. But now the U.S. is restarting travel in November, right? You're going to be able to travel into the U.S. from all around the world if you're vaccinated. At least that's what the guidance seems to be. So we're going to see a resumption in international travel. Demand for jet fuel is going to pick up. At the same time, we're going into winter, and we don't have enough gas to keep the world warm, and that's going to lead to a surge in demand. So it could potentially happen sooner, the $100 oil. And I think that's where the winter premium plays a big role here.
So how high could oil prices go? I mean, if we're talking about $100 barrels by September next year at the latest, based on the current dynamics, could we get to 110? Could we get to 150?
Well, I mean, I don't want to create necessarily headlines without writing them before, because otherwise I get into trouble with our compliance officers. But you know, I have to tell you, I mean, this seems to be increasingly a multi-year problem, because companies are reluctant to invest until higher prices come about. And even if prices come about, they still don't know what COP26 is going to look like. My sense is, once we get through COP26, we'll have a clear picture of what it's going to take to resolve the problem. But the climate summit will provide a lot of guidance to investors and governments and companies alike as to what they need to do here.
Francisco, very quickly here, we're out of time. Do you anticipate $100 like we saw 110 average for 4 years?
I don't at the moment. I think it's a squeeze. We've been factoring in more electric vehicles, a transition away from hydrocarbons. But again, we have an underinvestment problem that we can't solve easily. And at the same time, we have surging demand because we keep printing all this money. And my concern is prices for oil and other commodities spike. And what are we going to do? Are we going to say this is transitionary and we're going to keep feeding more money and increasing our debts, our government debts to cure the problem? That's definitely not going to help our transitory inflation story. I think it could make it more entrenched, but I'll leave it there. But I mean, you know, I think at the moment it looks transitory, but I think it becomes more permanent if we use the same tools we have, fiscal and monetary, to address what's essentially an undersupplied problem right now.
Interesting. Francisco, we could go all day, all morning. It's great to catch up. Francisco Blanch there, Bank of America. Two of the best on Wall Street this morning, Jeff Curry and Francisco Blanch, commenting on this crude market, Tom, and they agree. In Jeff Curry's words, the revenge of the old economy starting to bite in this commodity market.
John, you interpolate oil $80 to $100 a barrel. That's regular gas, $3.18 to $3.94 a gallon. It's a little unfair to do that, but let's try. It's just TV.
And Tom, to your point, it's not just about how price responds to additional demand. It's about how price and that response persists over time. And I think that second point is really important. Traditionally, we talk about higher prices correcting higher prices. Francisco's pushing back against that a little bit.
Yeah, absolutely. I mean, the inertial force here of commodities up is something all of these people, Ed Morse, Jeff Curry, Francisco Blanch, the others we talked to, that's what they're saying.
Fantastic conversation. If you're just tuning in and you just missed it, we'll get that on Bloomberg.com and on the Bloomberg terminal for you in the next couple of hours. Equity futures down 35 on the S&P. We're negative 0.8% from New York City. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Senate Republicans have blocked a bill that would suspend the debt ceiling until December 2022. It would also have kept the government operating past the end of the fiscal year later this week. That increases the pressure on Democrats to find a way to raise the debt ceiling and avert a crippling default. They now may have to use a budget procedure that could take nearly 2 weeks. China is signaling to markets that whatever happens to Evergrande, its debt crisis won't spiral out of control or derail the economy. Today, the central bank added $15.5 billion of liquidity into the banking system. That's the 8th straight day of injections. Earlier, the bank promised to ensure a healthy property market and protect home buyers. European nations dominate the top of Bloomberg's COVID resilience ranking for a third month, and there's a new #1 in the ratings. Ireland is at the top of the survey, whilst the previous #1, Norway, fell to 10th. Ireland has been steadily moving up since the start of 2021, when it had the worst outbreak in the world. Meanwhile, the Delta variant has left the US reeling. It fell 3 spots this month to number 28. Ford is making the biggest investment in its history. The automaker and South Korea's SK Innovation will spend $11.4 billion to build factories in Tennessee and Kentucky. The project will create 2 vast sites to produce electric F-150 pickup trucks and the batteries to power them. They'll employ almost 11,000 people. Ford will spend $7 billion for its share. And an analyst says that software developers are the new bankers, and he predicts a record wave of job cuts will soon hit the banking industry. Wells Fargo analysts, led by Mike Mayo, estimate that technology improvements and automation will allow banks to cut 100,000 jobs over the next 5 years. Banks spend more on technology than any other industry. Global News 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
City.
We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Oil prices are up since your Concho deal, but some are saying that that is too high of a price. Maybe you paid a little bit too much. How did you come to the right valuation?
That's what's great about our cost of supply framework inside our company, because it's agnostic to price. So to fit our framework, Alex, the all-in cost of supply needs to be below $50 a barrel WTI.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We will be very fast in getting a result for this government, and it should be before Christmas if possible. On the other hand, you should know Germany always has coalition governments.
And they've got to build a new coalition now. That was Olaf Scholz of the PD from New York City this morning. Good morning. Alongside Tom Keene, Elisa Brambis, I'm Jonathan Ferro. Equities futures are softer by 30 points. We're negative 0.7%. The Nasdaq 100 down by 1.3%. Relative outperformance on a small caps. Yields with a lift, Tom. TK out 4 basis points to 153. It's that cyclical trade we're debating all over again. Are we going to get a second run at this, or is this just a head fake?
I agree. You mentioned, I believe, John, February, March, and it is terrifically a redux of that. The one difference this time is oil. The one difference is commodities.
Big breakout in crude. And great to catch up with Jeff Curry earlier this morning.
Yeah, and then
Francisco Blanche. Just the underinvestment we've seen in the old economy commodities, Tom.
Yeah, I can't. Well, as I opened it, I thought, John, you got to the headlines nicely, but I can't get my glasses on today. John, as I opened it, I mean, this is a huge misunderstanding of how tight the market is, and when it goes, these elasticities just make the price move faster than you ever could think.
Seeing that in a big way this morning. Brent crude at $80 a barrel. Francisco Blanche and a team at Bank of America looking for triple-digit crude in the middle of next year. And as according to him, Tom, we're one cold winter away from getting it sooner.
For what it's worth as well, John, the tape a little bit more constructive in the last 30 minutes. Yeah, absolutely. Let's get now to Washington. Anne-Marie Horton with an important conversation after the German elections. Anne-Marie?
Thanks so much, Tom. And that's right. I'm joined by the European Commissioner for Trade and Executive Vice President Valdis Dombrovskis. It's his first visit, Tom, to the United States post-pandemic and under a new administration. Yesterday, Mr. Dombrovskis, you met with Chairman Powell, you met with Secretary Yellen. Today, you're meeting with Gina Raimondo and also Trade Representative Catherine Tai. This new administration and this meeting you're going to have on Wednesday regarding technology on trade, it was really billed on both sides of the Atlantic as a new beginning after some thorny trade policies with the former administration. But do you feel like you are getting what you need out of this Biden administration? Is it, quote, back?
Good morning. Well, indeed, we are now having a very intensive engagement with the Biden administration and working closely in many different areas. And one can say that indeed, America is back, and we saw it in many important initiatives of the Biden administration, rejoining the Paris Agreement, helping to reach international deal on business taxation, on the OECD framework, grounding Airbus-Boeing dispute. So just to give a few examples. Of course, there are still remaining irritants left by Trump era, which we need to resolve in the trade area. And I'm also very much looking forward of launching the Trade and Technology Council tomorrow, where we are concentrating on a forward-looking agenda, how we can cooperate in those areas.
But at one point, the French even want to postpone tomorrow's meeting because of this submarine spat. And for the most part, the EU was also vexed with the United States over this. It was just a French defense contract. Why was the EU also so upset?
Indeed, there was a disappointment in the EU concerning how this AUKUS situation was handled, because EU was neither consulted nor even informed about those developments, and as you rightly noted, it then ended up with a cancellation of a large contract for a French company. So there were some repercussions in the EU, and we were in intensive consultations with Biden administration to, in a sense, straighten this situation. But I would say it's especially in these kind of difficult situations, it's important to keep communication channels open, and it's important that we are talking as friends and allies, also in situations where we disagree.
There is still the Trump-era tariffs on steel and aluminum. And are you planning to get a deal done before this deadline in December? And would a quota system be acceptable for the European Union?
Well, indeed, we are now working very intensively to resolve this Trump-era steel and aluminum dispute, and indeed it has to be resolved by 1st of December, and actually allowing for internal decision-making procedures in the EU. We really need agreement already by the beginning of November. So later today I'll be meeting Secretary Raimondo, Ambassador Tai, and we'll be speaking, among other things, also also very much on this issue because time is in a sense running out. So what are important parameters for the agreement from our side is first that this agreement respects the historical trade flows between EU and US before Trump administration introduced those tariffs, and second that the solution is compatible with WTO rules.
And if you do not get an agreement, you will have your rebuttal tariffs automatically in place in December, or will you try to push those and punt those down the timeline?
Actually, we already postponed those tariffs for half a year after our first consultations, and now we are working exactly with this timeline in mind because those tariffs are kicking in automatically. So, but this was a timeline we knew in a sense from the very beginning, and both from EU side and US side, we are working with this timeline, so I'm hopeful that we'll be able to resolve this dispute.
Vladis Dombrovskis, thank you so much for your time. John, that was the European Trade Commissioner, Vladis Dombrovskis, coming to talk to us before he heads over to speak with Catherine Tai and Gina Raimondo
Anne-Marie,
today.
thank you. It's good to catch up. I'm Washington correspondent down in Washington, D.C. Tom, do you want to check in on this price action quickly? Futures down 29. Just to give you a recap, an update if you're just tuning in on TV and radio worldwide. We are softer. We're negative 0.671% on the S&P. Some clear underperformance on the NASDAQ yesterday and today. Negative 1.34% on the NASDAQ 100. And a lot of this playing through what's happening with the bond market right now. 10-year yields up 4 basis points to 152.35.
Well, almost green on the screen on small caps, and John, it is 7:54 Wall Street time. So we do quote the Dow. The Dow, a negative 2 something here. Negative 1 something here, down to 34,000, under 35,000 on the Dow. It's a crater. John, we're down less than 4%. It's a drawdown of less than 4% on the Standard & Poor's 500.
It's interesting to see this with Treasury yields breaking out, though, Tom.
It's true.
That's the new ingredient here.
We are just so addicted to up, and away.
Does it smell like spring, Lisa Abramowitz?
Well, this is the question, right? First of all, how much legs does the move in Treasury yields actually have, right? I mean, we are hearing some disagreements there. How much is this a buying opportunity for some people, like 5-year Treasuries? Like Priya Misra says, I don't know. It's too early to say that this is actually a shift in the mindset. It's also too early to say this is completely a reversion back to
It's also just too early, Lisa.
Thank you. It is too early.
It is.
All right.
Tom King.
Should we go home?
Lisa Abramowitz, Jonathan Ferro.
You're like, please go.
10 a.m. Eastern time. We'll go home. Futures, negative 0.7% on the S&P. Yields a bit higher by 3 or 4 basis points. Later today, Chairman Powell, Secretary Yellen, testifying on Capitol Hill. We'll be taking that on Bloomberg TV and radio at about 10 Eastern time. Do not miss that. This equity market, we have been debating the cyclical trade, the return of it for months now. Is this it, or just a bit of a head fake? Small caps outperform.
Electricity subscriptions, it's a part of this new business area that we have called the clean energy services. So the purpose with this new business area is to contribute and to create this biggest movement in the world for renewable energy. we will add even more products. We have solar panels that we sell, and now we have the soon, I should say, the electricity subscription. So it really fits that ambition that we have to, within the frame of life at home, the most important place in the world, we can add more value to our customers to live more sustainably. And this is a big part of the climate positive strategy that IKEA has for 2030, that we will remove and reduce climate emissions more than we emit in our entire value chain.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The market is starting to look forward to the healing in developed economies.
A lot of things are changing right now that are leading to higher yields. A market really edging towards reflation.
If we were to have a real debt crisis and a default crisis, the Fed has options.
The deceleration in growth and inflation will mean that even the most hardened of hawks, no matter who they are, is going to have to recognize it's really challenging to start tightening aggressively in 2022.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Oil, $80 a barrel on radio and television. The marginal gallon of gas, it is going up. John, you link it all together. It links to some form of inflation.
Crude higher, yields higher, 10-year yields, Tom, 153. This equity market breaking down a little bit on the S&P by 0.7%. TK, the focus. That NASDAQ 100 down by 1.5%. Underperformance yesterday, again this morning.
We're not going to take the time here, folks. Higher yields, maybe it changes the mathematics on those ratios used to measure the value of the high tech. But it is, John, high tech under siege, small cap does better.
What's the tolerance of this equity market for high yields? Last time around in spring, do you think this smells like spring? In spring, we pushed 180.
You sound like a Bramlett.
We pushed 180, Tom, 30 basis points north of where we are right now. So clearly there's scope for yields to go even higher. When do we start to get that bite point? Is it now? Is it later?
Lisa, what's the biggest worry?
Right now, I don't know about the biggest worry, perhaps China, actually. If I read a lot of notes, people are looking to the slowdown in China and the bleed through to the global economy. What I'm wondering is this a new type of reflation trade? That basically, if we talk about higher oil prices and we talk about higher inflationary input prices, how much does that crimp consumer staples that at some point can't pass along all of the costs to consumers? This is what I'm going to be watching with this earnings season, Tom.
I was having breakfast with John Farrow yesterday at Popeyes. It was. I forget which one. We were at Popeyes having breakfast, and I said to John, we've got to do a bull case going on right now. We're going to do that with Sarah Malik in a moment. John, Malik, Ben Laidler, Anna Hahn over at Wells Fargo, Bovan we heard in the opening from BlackRock. They're stating the bull case.
The beauty of catching up with Sarah, Tom, is that we can do single names as well. And I'm thinking about the Nikes of this world. How many Nikes will we see this earnings season? It was a miss but it was a supply-constrained miss. Do you want to buy names that are hit by supply-constrained stories because their demand is still robust and their demand could persist into next year?
There's the optimistic tone, and we go to the VIX. Not so optimistic, out over 20, 21 earlier. John, 20.60 on the VIX right now.
It's a change, Tom. Your equity market comes in 0.75% on the S&P. Yields are higher by 4 basis points to 153. And crude, let's sit on that for a moment.
Yeah, let's
76 on WTI. 80 on Brent. Jeff Curry of Goldman Sachs, Francisco Blanch of Bank of America on the program, on the shows this morning, in the last several hours this morning, suggesting crude can go much higher.
And you interpolate it out, John. $3.94 a gallon on gas is one eyeball I had on where you go from $3.18 as you go to $100 a barrel. Should we stake the bull case right now, John?
I think we should do that immediately, Tom.
Let's do that. Sarah Malik joins us, Nuveen Global Equity CIO. Far too optimistic to be on this show. State the bull case where this swoon, as you call it, is an opportunity.
The bull case is around earnings growth for next year, which we think can be in the high single digits. But the concern today is whether yields are moving too far too fast. And the issue is that as monetary policy becomes contractionary instead of expansionary, how do we get to this growth rate? What we're looking at is a strong consumer, strong manufacturing data. All of that should continue. And really what we're seeing here is growth is just being postponed. It's not evaporating in the third year of a bull market post the deep recession. We can see the strong earnings growth. It's going to come from the top line and pricing power because margins are at about decade highs. So companies with pricing power who can overcome inflation should show that earnings growth going forward.
So revenues will outstrip any margin erosion.
That's our view, and we're looking for those companies with the pricing power. So let's talk about Nike here, where it really was a supply issue on the guide down. They have a lot of brand heat. Demand has never been healthier for Nike. You can wear Nikes anywhere. I'm actually wearing a pair right now as we do this video.
What is this, an endorsement?
Carry on, Sarah.
Also for Nike, they're shifting. Their margins should increase as they move from wholesale to retail, more direct-to-consumer business, and the Vietnam factory is reopening right now. And they have scale. So when those ports do become less congested, Nike's going to have more power in that area. So we think going forward, actually, they can beat earnings next year.
Is that a template, Sarah, for you through this earnings season? Does that story open up some opportunities? If we see more Nikes through earnings season, are they buys for you?
I think likely we will see a lot of companies talking about supply chain issues and perhaps missing earnings because of it. What we're looking at are those companies which have the power of the reopening behind them and can overcome those supply issues. Another name we like is Simon Property Group. This is an A-mall company here. Malls are not dying. If you look at Simon Property, a lot of retailers want an omni-channel business, a combination of brick and mortar and online. Brick and mortar is becoming much more cost effective. And to get that online traffic, you want to have foot traffic through your brick and mortar. You look at something like Simon Property, it's trading at a discount in the REIT sector because it's a mall. So we think that's another strong play going forward.
Banks are bouncing back as well with a steeper yield curve and high yields through the whole of this curve, Sarah. Where do you like the financials right now within the banks themselves? We've talked about this before. Goldman, very different to Bank of America. Take your pick in financials at the moment. What do you like? What kind of business model do you want exposure to?
What we like about banks are the yields, but what we don't love about banks are the valuations. We don't think they look particularly cheap. So if you want to play yield on banks, you're exactly right. Look at a Bank of America that's pretty levered to yields. We like companies more like Morgan Stanley, which has more of a consistent, stable business in wealth management. And then we like our mid-cap bank, Fifth Third, which has more of a strong Southeast regional footprint. Also, they have a strong business model. They're rolling out new products, a lot of cash on the balance sheet so they can really leverage the yields that are going up going forward.
As you lean into a reflation type trade, how much does oil at $80 a barrel going up potentially to $100 a barrel challenge the view of, say, airlines, of certain cyclical stocks that might not be able to pass along the cost so easily?
But we don't love the cyclicals that don't have pricing power. So exactly that. We're not looking at maybe what are lower quality or highly cyclical companies at this point. Energy is going to be an issue. You have to have that pricing power and demand in place. So airlines are not necessarily a favorite for us. We would play companies related to airlines like Boeing, which has the leverage because they're supplying to airline companies, but less volatile and less cyclical than a pure airline.
So today we're going to hear from Jerome Powell. We already heard from Christine Lagarde of the ECB talking about the transitory supply chain disruptions, the transitory inflation inputs. How transitory, based on the ground level view of corporate balance sheets, do you expect the supply chain disruptions to be?
No, we don't think we're at the peak of inflation at this point. It will be mostly transitory, but there's going to be some permanence going forward, especially in larger pieces of inflation like wage inflation. So, going forward, maybe inflation is more in the 2 to 3% range. The question is, how hot is that for the Fed? Powell does tend to lean dovish, so we're on the side that the Fed does not make an error here. Our view is even that interest rates may not increase as quickly as the market is thinking with the moderate growth that we expect next year.
Sarah, I've been going back and forth with Doug Cass all morning. I mean, we're not in speaking terms because the Yankees are crushing the Red Sox, but Cass is all bent out of shape about buybacks and all that. What's use of cash going to do given this maelstrom?
I mean, it's interesting because you've seen really high levels of buybacks this year, and this kind of tells you that companies are not confident enough right now to spend on CapEx. Buybacks tend to be more flexible. However, we think that will likely peak going forward. We're seeing low inventory levels. Our view is that companies could shift to more capital expenditure going forward and pull back on buybacks. So maybe buybacks continue and peak around the end of this year, and then we switch to more of a CapEx-based model as companies become more confident as the Delta variant moves behind us.
Sarah, I missed you last time. It's been too long. It's good to see you and great to catch up.
Good
Sarah
to see
Malik
you.
there. Thank you. Nuveen Global Equities CIO. You're right, TK. I missed you sometimes. You take a straight day off.
Can I put this in perspective? She mentioned Simon Property Group, one of the great class acts of the investment world. They have been crushed. I mean, they are down 2.4% from their post-pandemic high.
I know where you're going with this. I know where you're going with this.
We gotta put things in perspective.
I agree. Can we put euro-dollar in perspective? Can I do that quickly?
Yeah, get juice.
Cratering. We're down about 1/10 of 1%.
George Saravellos.
116.79. President Lagarde opening an ECB forum and saying the following: the ECB must not overreact to transitory supply shocks. The Federal Reserve, I imagine, would agree with the ECB. But I think if you want to wake up this FX market and get some clean directional trades on the likes of euro-dollar, we need to see some divergence between central banks, Tom. And just given the way things are starting to set up for next year, maybe we might see that between the ECB and the Federal Reserve to the back end of next year.
I think they're both massively data dependent. I get where you're going, John, but I don't know how you do that if you don't have a plan, if you don't have a theory, if you don't have a belief. And right now, they're all just staggering to the next set of economic data.
You'd have to say, though, the ECB will be much more reluctant to raise interest rates, Lisa, than, say, the Federal Reserve.
And not just raise interest rates, but also even pare back their bond purchases, given some of the political pressures in the region. I also want to note, this is one of the biggest economic experiments in terms of how you deal with the labor market. Clearly, there's more slack in Europe following the plans that they did to try to support people and keep people employed versus U.S.'s sort of money spray that they did with respect to checks to households. I think that we're going to be talking about that for years to come.
Is this labor market tight or is it loose?
I mean, this
Have we
is
got
a
lots of slack
test.
here or
well,
no?
Would you agree that there is more slack in the European market than in the U.S.?
I don't know how much slack there is in the United States to say. The problem is, if you look at job openings, it looks like a tight labor market, doesn't it?
There are a lot of people who speculate.
You look elsewhere and it doesn't look so tight.
The issue is, are there people who are waiting to go back to work because they have funds in their savings accounts? That is one of the big question marks, and that's one thing that we have not yet seen, even as the enhanced unemployment benefits
Have you
roll
got
off.
funds in your savings accounts, Tom?
No.
No?
How many Amazon boxes?
You look very disappointed about that.
My bank is Amalgamated Tuition.
Okay. Tom Keene, Lisa Bravis, Jonathan Ferro. I shouldn't have brought that one up.
No, you shouldn't.
You sound a little bit upset. We're down 32.
We're squeezing 4 years into 5.
We're negative 0.7 of 1%. From New York City this morning, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. Pressure is mounting on congressional Democrats to raise the debt limit and avert a crippling default. Senate Republicans have blocked a bill that would suspend the debt ceiling until December 2022. It would also keep the government operating past the end of the fiscal year 2 days from now. Democrats have offered no immediate backup plan. Brent oil has broken through the $80 a barrel barrier. The leading crude benchmark rose for the 6th day in a row to the highest since October 2018. There are signs that demand is running ahead of supply, and there have been a flurry of bullish price predictions from banks and traders.
Where is that hurdle rate? Obviously in oil, we're near $80 a barrel. In fact, we're over $80 a barrel this morning on a Brent basis. And if we look at the rig counts in the U.S. and other parts of the world, they're showing you, hey, $80 a barrel is simply not enough.
And Goldman saying prices could hit $90 a barrel this year. Japan may kick off the process to sell an $8.5 billion stake in Japan Post Holdings this week. The government plans to cut its stake in the postal and financial services giant to 1/3, the minimum it's required to hold by law. More money from the sale will be used to pay for reconstruction of areas devastated by the tsunami and earthquake in 2011. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you went to Harvard Law School, did you say, maybe someday I'll be on the Supreme Court?
Anybody who thinks maybe someday I'll be on the Supreme Court, I don't want to say there's something wrong with him, but there is something wrong.
The companies that can move the fastest and be the most agile, no matter what change comes their way, no matter how fast it comes their way, these are the ones that are going to survive and thrive. China's a good example of that now. You see across the board some of the rules and regulations that are changing, or maybe the uncertainty that's coming out of the Chinese government, and they're trying to deal with some of the local challenges that they have, both in terms of how to manage the asymmetry between the haves and the have-nots locally. They're trying to deal with the issues of managing data and security and other aspects like that. The companies that can operate in China and around the world collectively in a bipolar way are going to be the ones that come out of this on top.
Are investors going to come out on top, though, or are companies looking to do business within China from the United States, are they going to come out on top at the moment, Bob?
Yeah, it's clear that the investors are in for what I think is going to be a bumpy ride. You see it today in terms of what's happening in the marketplace.
Watch Bloomberg Surveillance to stay on top of the latest market trends, commodity trends, and fashion trends.
Are you going out for a fitting on a base suit?
I'm going to go and get a base suit. The crowdfund was very profitable.
$100,000.
Came in at about 100K, which is what it would take for me to wear that suit on this network. How do you get that bulky fit? I'll find out. I'll have a chat.
You get
the bulky one.
You know, on a channel in the press.
Look at those markets.
Don't taper the pants. They give you just down
so
6.
good in a base suit.
Keep
dreaming.
Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Champion approved Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And It is very powerful, and I'm a big believer in it.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
You know me, I'm more an optimist. I think things are going to go well. I think we're going to get it done. Well, it may not be by the end of the week. I hope it's by the end of the week. But as long as we're still alive, we got three things to do: the debt ceiling, continued resolution, and the two pieces of legislation. If we do that, the country's going to be in great shape.
The President of the United States addressing some of the issues down in Washington at the moment. From New York City right now, good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. As we march towards the opening bell, 1 hour and 12 minutes away, equities are softer. They are off the lows. We are down 0.75% on the S&P 500. Negative 33, the NASDAQ 100, negative 1.5%. That is where the underperformance is. Off the back of this move in Treasury yields, we are higher by 4 or 5 basis points to 153.39. Crude through 76, Brent through 80, the story of this morning. We're up there, Tom, by 0.9%. Let's call it 1 percentage point higher in the oil market.
Right now, and that's a good point to be $80. Well, we're just under $80 a barrel, $79.95 on Brent. Dan Clifton always writes with a real sense of American political history. His latest note is simply a jewel. He's a strategic research, head of policy research. Dan, I love what you do about the ascent of the Tea Party 12, 13 years ago. And in November, a decade ago, basically the Tea Party collapsed. How do you bring that forward to the Democrats of 2021?
Absolutely. First, thank you for having me. This is a very big week in Washington. We're calling it Field of Dreams Week, as Speaker Pelosi tries to build legislation, and hopefully the votes will come. As you know, the progressive Democrats have been pushing for a ironclad commitment on a $3.5 trillion spending package. And if they get that, they would agree to an infrastructure package that was negotiated on a bipartisan basis. We are nowhere near a $3.5 trillion deal. And so Speaker Pelosi made a very big shift last night and said, I am going to de-link the infrastructure bill from the $3.5 trillion spending package. Let's take the win on infrastructure, and now we're going to have a test of whether the progressive Democrats are the equivalent of the Tea Party in 2011 and 2012. Tom, as you remember, in the week before the fiscal cliff of 2012, the Tea Party took down a bipartisan negotiated agreement on the fiscal cliff in direct opposition to what Speaker Baker wanted to get. And as a result, they ended up with a much worse deal and eventually the collapse. So this is a very big test for the progressives here. Pelosi is challenging them. And ultimately, I believe an infrastructure bill will pass this week.
Dan, are they whippable? Are they so intransigent that I can't even pronounce it correctly? I don't have a fancy degree like Clifton, but are they whippable?
It's a great word, and I do think they are whippable. They are whippable if the President of the United States picks up the phone, even goes to their lunch this week, and says, I need your vote. The President is in quicksand here. He's got higher inflation. He's got COVID issues where he's underwater with the voters. He has the Afghanistan on foreign policy. He needs a domestic policy win. He needs to put it out there. There's 2 points of pressure. Number one, I need you for this win. The momentum will get us to a larger spending package down the road. And second, the Highway Trust Fund will completely expire on October 1st. We don't want those jobs to go away, so I need your vote. But it's not a one-way street, Tom. He's going to have to go to Senator Manchin and Senator Sinema and say, I need something bigger on the $3.5 trillion spending package so I can go back to the progressives with something. Dan, ultimately, I believe that that's going to work, but this is as high stakes as I've seen it when you can only lose 3 votes in the House of Representatives.
Dan, you said that you do believe that an infrastructure plan will pass. I assume this is the bipartisan infrastructure bill that will pass this week. Where does that leave the debt ceiling debate, the potential government shutdown, if at all? Does it help move the needle in that direction?
Great question. Completely separate, but everything is connected in Washington. Last night, we had a vote in the United States Senate to continue that government funding and to lift the debt ceiling. As you know, that vote failed. And so we're beginning the step process of where we're going on this. My guess is that the Democrats in the Senate are going to remove the debt ceiling, pass a continuing budget resolution, and that will ultimately pass the House of Representatives. Then we're going to have to figure out what we're going to do with the debt ceiling. And I do think the Democrats are starting to come to the realization that they're going to have to do it alone through the budget reconciliation process, and it's going to take about 2 weeks for them to get there. So this is for me, I'm much more worried about the debt ceiling resolution. You're already seeing short-term interest rates in the one-month market really starting to bid up here as investors are worried about getting paid for. That's going to have a far bigger impact on financial markets than the infrastructure. But Lisa, think about the question you just asked. Think about all the bandwidth. Each one of these are very difficult, and we're trying to do 4 of them at one time in a very short time frame with limited majorities in both the Senate and the House. This is as high stakes as I've ever seen it.
What's the historical analog to the potential for the United States to default here? I mean, is it 2011, or is this unprecedented in the potential here for an error?
Yeah, so we've been calling this a September to remember because it reminds us a lot of September 2013. Do you remember in September of 2013, the Fed was trying to taper, Bernanke's replacement was on the table, you had a government shutdown, we had to raise the debt ceiling, and the ACA exchanges were coming online. That's very similar to what we are today. And ultimately, Lisa, we had a government shutdown. That made it easier to raise the debt ceiling because once we got into a shutdown, we had to reopen the government, and then we attached the debt ceiling to it. So there is an analogy there. In 2011, which I think is another good analogy, that was the Republican Tea Party challenging on the debt ceiling. Today, it's a little bit different because you have one-party government, and usually when you have one-party government, that party raises the debt ceiling by themselves. And there's ways to do it. It's just we're going to need the pressure to get policymakers to act, and that's why I think you're going to see some strain and some volatility in the short-term credit markets until we get that resolution.
One-party government made up of about 3 different parties. Dan, that's the issue, isn't it? 2-party government in name only, really. 2-party DC. There's about 5 different ones, Dan, that are trying to agree on something. Isn't that the myth here down in Washington? It's always been true to some degree that there are only 2 parties in Washington.
That's exactly right. And, our presentation into the presidential election was there's really 4 political parties. You have your establishment Republicans, establishment Democrats, and then your progressives and your Trump Republicans. And for the Republicans, they've just been much more advanced over the last couple of years. Now you're seeing that 4th party really develop on the Democratic side. And I think the key question is, Speaker Pelosi is the best whip that I've ever seen in my lifetime. She knows where to get the vote. She knows exactly how to apply the pressure. But Jonathan, she's a lame duck speaker, and do the progressives seize that as an opportunity, try and burn the House down until they get what they want? My guess is that they're going to not let perfect be the enemy of the good. They're going to wind up moving the ball forward, but it's going to take a lot of work from Pelosi and Biden to get there. And then ultimately, I think there's a lot of work getting done behind the scenes to get some sort of reconciliation package through, somewhere in the range of $2 trillion. That's going to have a meaningful increase in healthcare and renewable energy spending. So not everything you want, but that's Washington. And you're going to have to accept that compromise, just like the Democrats did with Obamacare in 2010. So we're really seeing those divisions play out. It's not easy to watch the legislation be made, but I do think that we're starting to see how this program is going to develop, and the Democrats are starting to get their game plan in place.
Hey, Dan, don't be a stranger. It's got to catch up. Dan Clifton there.
Fired up.
Strategas from New York City this morning. Good morning. Tom Keene, Lisa Brabbits, and Jonathan Ferro. Equities down 0.8%. Yields are higher. Crude's rallying. This is Bloomberg.
Boosters work, and they will definitely help. the boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? Should probably up that some. You get infected 3 times, your immune system is like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
So recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Equity struggling this morning. Good morning to you all from New York City on radio and TV. This is Bloomberg Surveillance alongside Tom Keene and Lisa Bravis. I'm Jonathan Ferro. Your equity market shaping up as follows. We're negative 0.8% on the S&P. The Nasdaq negative 1.5%. Outside of that, yields higher. 5 basis points on 10s, pushing 154.
Yeah, up we
30s
go.
through
Punching
2%.
through right now.
2s, Tom, through 30 basis points. It's a real change, helping this move out. Crude up by 0.5% off the highs of the session, but still through 75 TK. WTI 75,
well, John,
90.
Let's stay on this. This is important. We're seeing a real breach here this morning, and we're going to get to this in a moment with Mr. Stanley, but I'm looking, John, at a 30-year bond, 8 basis points. That's yield up, price down 2.08%.
If you'd asked me to guess last week what would happen if we repriced rate hikes to the degree that we are through the front end and the belly, Tom, I would have expected the long end to come in a little bit, or at least stay up there and the curve to flatten. It hasn't developed that way. That's kind of what we saw on Wednesday after the Fed decision, and then yields just clicked higher on 10s and 30s too. That's taken me by surprise and clearly easy to explain now, Tom, but the whole curve with a lift here, the longer end particularly.
A little bit of yield curve lift, but today it's a long end story. Stephen Stanley joins now Amherst Pierpont with acute abilities at market economics. We're thrilled he could join this morning. I'm going to cut to the money quote, Steve Stanley. We are grossly too dovish. Why are we grossly too dovish? And what are we going to do about it?
Well, I think the market's kind of voting with its feet at this point, but certainly it feels like last Wednesday's FOMC meeting was kind of a seminal moment, and I think people realize now that the Fed is serious. Not a great surprise that we're going to begin to taper in November, but I guess the reality of it was kind of a splash of cold water in the face. And I think maybe more importantly, if you look particularly at the shorter end and the belly of the yield curve, is market participants are thinking again about rate hikes. And I think that was kind of inevitable the minute that tapering was a reality, that people would move to the next step, which is when are we going to get liftoff? And the Fed has moved that timetable forward quite a bit over the last 6 months. And I think, again, market participants are starting to see that we're actually getting serious about it.
Stephen, young Turks like John Farrow and Lisa Bramos, they look at the 10-year yield, they look at the Standard & Poor's 500, I look at the Dow Jones Industrial Average, and I always look at the 30-year bond. You suggest the 30-year bond is way, way below any kind of appropriate measure.
Well, look, I mean, even if the Fed's right and inflation comes back down to 2%, I mean, that leaves you with basically no real return for 30 years. So you really, things have to play out pretty perfectly for that to be a good investment over the long term. Not, obviously not making a comment about what might happen the next day or two, but, really yield levels have been very low, and I think have been consistent with this emergency stance of policy. And now that that's going away, I think market participants are thinking about, okay, what makes sense here, and obviously yields are drifting higher as a result.
Well, let's talk about what makes sense through the front end and the belly of the curve right now, Stephen. 2's through 30 basis points, 5's through 1 percentage point. You raised the important question here. We're starting to price in some kind of rate hiking cycle that begins perhaps at the back end of next year, the turn of next year into 23. The conversation we're having is to try and work out how shallow or steep that rate path will be. At this point, Stephen, I think that's almost impossible. What's your thoughts on that? When you speak to clients about that at the moment, what do you tell them?
Yeah, well, I think, firstly, I would say that a lot of people in the financial markets are keying off of the last cycle, 2018-19. I think there's a broad consensus that the Fed tried to raise rates and they got to a certain level, right around 2%, and things got tight and the economy weakened, and therefore the Fed is never really going to get above that level. And one thing that we saw last Wednesday that didn't necessarily get as much press as some of the other headlines is extending the dot projections out to 2024, and the median 2024 dot is well ahead of what markets were pricing in for that point. So I think the Fed actually believes that we're going to get back to something close to their view of what a long run neutral funds rate is, which is 2.5%. And the markets have been, working under the assumption, at least until last week, that we were really never going to see anything above 2% for a very long time.
So my question for you then, Stephen, is a question for an economist. How high a rate can we tolerate in the economy we have right now with the debt we added to it over the last 12 months? We have real yields still negative 86 basis points. Can we get back to zero without turning this economy over? They're the kind of questions I think we've got to ask as economists now, Stephen. What are the answers to them?
Yeah, well, here's what I would say about that. I mean, you look at the household sector and the business sector, and both of them are very flush with cash. Households are sitting on, call it, an extra $3 trillion that was accumulated over the course of the pandemic with a lot of the fiscal relief. So the flip side of that government debt that you mentioned is that households are sitting on a lot of cash. Businesses, same thing. They've borrowed at rock bottom rates and piled up quite a bit of cash. So the private sector is not going to need to borrow a lot to sustain growth. So yeah, we do have a government debt issue, but the private sector, I don't think, is going to be particularly sensitive to a rise in rates here. I mean, it will have impacts at the margin. Certainly it'll have an impact at the margin on the housing market because people don't pay cash for houses for the most part, maybe on the auto market at some point. But for the economy broadly, I think we can power through given how much extra liquidity that households and businesses are sitting on.
Stephen, do you think that you're in the majority among your fellow economists when it comes to this view that we can tolerate substantially higher yields, or do you think that you're in the minority?
I don't know. I feel like I'm never in the majority about much of anything. I think that I think that there's still a view that that rates are going to have to remain low. I think that's a broadly held view still, but starting to loosen up maybe a little bit. I think the other thing that we haven't even talked about yet is the possibility of inflation actually being higher on a sustained basis, and that presents a lot of upside risk. I mean, really, the entire conversation that we've had so far kind of implicitly assumes that inflation gets more or less back to where the Fed wants it. And that may happen, and I think that is the consensus view, but there's certainly, and even the Fed acknowledges that there's certainly considerable upside risk to that view, in which case the Fed might actually have to move beyond neutral and actually, run a somewhat tight monetary policy for a while to tamp inflation back down.
The reason why I asked whether you were now, is this just a case of who can be most dovish and let the economy run hot? Is this, as Tom has been talking about, an ex post, facto Federal Reserve, and will be by nature, by design, with whoever is appointed next? Or is there something else that could take hold with these new appointees?
Right. Well, I do think that the appointees to the board are likely to push it somewhat in a dovish direction. I mean, I think the administration is going to want, even though I expect that Powell will be renominated, I think the way of kind of balancing that on Biden's left flank is to put some people on the board that the progressive wing of the party would like. And so that will push us to some degree in a dovish direction. I mean, certainly in recent history, board members have been kind of in lockstep with the chairman. So I don't know how much that will change. It hasn't always been that way, and we might get some outspoken people on the board. It's too soon to say anything about the two bank presidents that are going to be replaced. We'll have to see how that process goes and who end up, what two people end up being the new bank presidents there. But I do think, if anything, the board will become more dovish than it's been already, and I've long argued this is the most dovish Fed in the history of the institution. So we're only moving in that direction. Right. I will say one caveat to that is that the kind of the trump card here, if you will, is inflation. Because if inflation does get too high, then it really doesn't matter hawkish or dovish. I think the Fed has to respond. If we're still in that gray area where it feels like inflation is under control, then the board and the FOMC have the freedom to maybe push the envelope a little bit, let the labor market run hot. But that all goes out the window if inflation is, moving at a clip that the Fed doesn't want to see.
There are no hawks at this Federal Reserve. Stephen Stanley, thank you, sir. Amherst Pierpont, Securities Chief Economist. Tom, another question as well is how involved this Fed board might be in trying to shape the views of the Boston Fed and the Dallas Fed in selecting new presidents. That could be interesting too.
I less think so. I think that, as we heard yesterday from Michael McKee and others, diversity is front and center, and those are two geographies where they can easily affect diversity.
Diversity of views as well, Tom? Do we need to think about that as well?
Well, they're different Freds. I mean, you've got a conservative tilt to the Texas Fed going back to Robert McTeer and beyond. In Boston, its own interesting soup with all the universities around and the play of the Boston Fed off of the Charles River. In Boston, Boston University, I'm going to put on the river as well. But John, basically, I have a great confidence the local boards will solve the issues Washington cares about.
A lot of questions for Chairman Powell a little bit later this morning, Lisa. That starts at 10 a.m. Eastern Time.
I still wonder whether this takes pressure off him in the sense that perhaps he has fewer questions to answer in terms of what the ramifications are for certain trading activity. However, I wonder if Stephen Stanley is going to be right, that the new Fed, the new composition of the FOMC will only be more dovish than what we've seen.
And how can you get more dovish than what we've seen?
What does that mean, John?
I've got no idea. All I know is that two hawkish dots go. Yeah. I mean, I say hawkish.
Yeah. They're
John, I was confused about BU because Zvi Bodie would come out of the Pardee building, and he was the closest of any professor to Fenway Park in the world.
Are you trying to correct something you said, Tom?
Yeah, I did. I failed. I went down in flames.
BU's not on the river. Okay.
Yeah.
You finished? Do you like this line from Katie Lyons in a story out on Bloomberg?
Yeah, she nailed that.
Investors who are male over the age of 45, married or consider themselves as having excellent investment experience, are more likely to freak out and dump their portfolio during a downturn.
It's a great story. You should read
it.
Did
you take that personally, Tom?
It's MIT study.
I wouldn't.
You're freaking out. We're down 8, 9 tenths of 1%.
Go to cash. Oh, wait, I'm already in cash.
Coming up, a lady who thinks you should not go to cash is Anna Han of Wells Fargo, the equity strategist out of Wells.
Oh, she's on your property
and a
today.
team with Chris Harvey.
Nice.
Catching up with Anna in about 20 minutes' time. From New York City, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. Senate Republicans have blocked a bill that would suspend the debt ceiling until December 2022. It would also have kept the government operating past the end of the fiscal year later this week. That increases the pressure on Democrats to find a way to raise the debt ceiling and avert a crippling default. They now may have to use a budget procedure that could take nearly 2 weeks. European nations dominate the top of Bloomberg's COVID resilience ranking for a third month, and there's a new number one in the rankings. Ireland is at the top of the survey, whilst the previous number one, Norway, fell to 10th. Ireland has been steadily moving up since the start of 2021, when it actually had the worst outbreak in the world. Meanwhile, the Delta variant has left the US reeling. It fell 3 spots this month to number 28. Two of Canada's largest gold miners are combining. Agnico Eagle Mines has agreed to buy Kirkland Lake Gold in an all-stock deal valued at $10.6 billion. It's the latest in a string of similar deals that has reshaped the gold mining industry in recent years. And Ford is making the biggest investment in its history. The automaker and South Korea's SK Innovation will spend $11.4 billion to build factories in Tennessee and Kentucky. The project will create 2 vast sites to produce electric F-150 pickup trucks and the batteries to power them. They'll employ almost 11,000 people. Ford will spend $7 billion for its share. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
What have we learned from this Evergrande crisis so far?
From my investment perspective, I think diversification is very important. So far this year, we've seen many events, right? Maybe in the fintech sector, and education, casino, and property. So I think diversification help you lower your risk on your overall portfolio.
Medium term, though, are you seeing more risk and reward in the high yield space in Asia? I mean, how are you viewing this right now? Are there actually buying opportunities given just the selling we've seen?
This time is a bit different in the property cycle, because in the last, when you see there's a tightening measure, there's always demand there, right? Just the government trying to suppress the demand. But this time we're seeing a confidence issue, is like a buyer strike. Because of the sentiment, the Evergrande is hurting the sentiment, and people don't want to buy. And other developer, because they want to get cash.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams. There are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We have an underinvestment problem that we can't solve easily, and at the same time we have surging demand because we keep printing all this money, and my concern is prices for oil and other commodities spike, and what are we going to do? Are we going to say this is transitionary and we're going to keep feeding more money and increasing our debts, our government debts to cure the problem? That's definitely not going to help our transitory inflation story. I think it could make it more entrenched.
Francisco Blanch, with our real focus on commodities today, thank you to all the major houses for perspective here on rising commodities, the idea of, is this a super cycle, a new super cycle, and a breakout? There are other sides to this besides Wall Street firms like Bank of America and Mr. Blanch or Mr. Curry at Goldman Sachs, who look at the extractive process and say, what's the future look like? We do that now with Colombia. And Diego Puyo joins us, their energy and mines minister, and of course with his tour of duty at the International Monetary Fund as well. We don't do this enough. When you look at the media talking about the extractive process of mining or even oil, what do we get wrong about the challenges you face in making supply happen?
I think in the extractive industry sector, we need to make sure that we have more stability, obviously, on the price side. And that's difficult because obviously it's determined by the market forces. So I think, it's understanding how the production levels will change once we have those swings in prices, either upside or downward. I think that could be one of the things that, is difficult to obviously forecast and understand the response from the real sector.
You bring prodigious academics to this, unlike many others in extractive mining. Do you call a commodity supercycle now after years of disinflation and outright price deflation? Is it time that we have turned and we're moving higher?
Well, it's looked like we're going in that direction, not only with oil, as we saw yesterday, Brent, for the first time, which is the Colombia reference, has crossed $80 per barrel. We've seen that with natural gas, obviously, in Asian and European markets. And we're seeing that with coal as well, which has recovered more than 75% in the last 12 months.
Well, how do you support your home industry, which is coal, with one of the biggest mines out there, while also remaining on the right side of the debate over global warming, on the right side of all of the development in terms of what's next for energy production going forward?
Well, Lisa, we know that we need to be more competitive because the demand for coal, for thermal coal, has been shifting toward the east. And we need to make sure that our companies are competitive in that market. So we've been helping those companies enter the Asian market. Some companies have done it very well, like, for example, Drummond and Cerrejón, obviously. And now, I think with Cerrejón, you obviously know that Glencore announced buying the stakes of Anglo American and BHP a couple of months ago. So I think that's a very good sign that they will continue to mine all of the assets in Cerrejón in the medium term. And Colombia obviously would like to see the coal sector to continue to thrive as done it over the last 3 decades.
Well, how do you get a foothold, though, in the new industries, right, the new energies? And I'm thinking of natural gas in particular, which is surging both in demand and in price.
So we've been doing efforts to award new E&P blocks. We had a problem in Colombia because when we came into power in 2018, the country had gone through a period of 5 years without signing new E&P contracts. So we cleared some bottlenecks on the contractual side. And in these 3 years, we've signed now more than 35 E&P contracts. And we have a new round taking place this year, which will be awarding contracts by the end of the year. So we're focusing also, obviously, on gas-prone basins offshore, but also in the Medium Valley in onshore basins that are mature in Colombia and are well known for its gas prone.
Is the mine mechanized or does it employ so many people it's a domestic labor issue for Colombia?
Even though it's not labor intensive, it is the main employer in the two provinces where we have
Like how
coal
many
mines.
people roughly?
About 10,000 people.
You get 10,000 people strapped to coal. You have, as Lisa mentioned, a global mandate to reduce coal. How do you juxtapose that? I mean, 5 years out, 10 years, forget about the limousines outside the UN or I mean, you and I have done IMF World Bank 47 times. Forget about the suits and ties. How do you juxtapose that out 5 or 10 years as we're asking China to diminish coal?
So, Tom, that's a very good question, and our main public policy in the sector has been energy transition. Colombia has world-class resources, both wind and solar, and it happens to be that the highest potential is exactly where the coal mines are, which is the northern part of the country. So we've done auctions, we've created a fiscal framework to attract investment into this variable or unconventional renewable energy sources, and we're going in 2018 from less than 0.2% of our power matrix made up of renewables to about 12% in 2022. And we see a significant opportunity for workers in these regions to move and have not only a just, but a well-managed transition over time to variable renewable energy.
Diego, we're talking about the potential for energy crises across the world. We see energy shortages, certainly in the United Kingdom. There's a potential for one in China. How do you avoid something similar happening in a place like Colombia from your standpoint?
So we need to make sure that we exploit our natural resources very well. So Colombia has a comparative advantage because right now our power matrix depends largely on hydropower. We have significant hydro resources. So what we're doing is we're complementing those resources with wind and solar, and obviously having about 20% or so of natural gas and coal power base load that we can complement the intermittency on water, wind, and sun. So our matrix is looking quite good. It's going to be better once we finish this, ramp up in energy transition process.
Let's get to the most important extractive commodity of Colombia. What are you going to do about the price of a cup of coffee? Help us here,
And that's something that it's under the agriculture ministry, but I think we're very happy.
But you're here, so we're asking you.
But my answer there would be, we're very happy to see strong prices for coffee.
Are we?
In Colombia, of course. and I think the demand for coffee maybe is more inelastic than what we think.
Are we? Really? Thank you.
No
Killing
kidding.
it here with the IMF analysis. Anything else you'd like to add?
No, I think I would like to add, the energy transition process that we've been doing in Colombia has a couple of very significant milestones that are taking place right now. So on Thursday, we'll be launching with President Duque the hydrogen roadmap. Colombia has significant potential to produce both green and blue hydrogen. And we also awarded 2 months ago the first auction in Latin America for large-scale storage with batteries.
See how he did this, Lisa? He got right back on
Yeah,
script.
well, he didn't even blink an
My
eye.
youngest daughter's popping $8 a cup of something at Starbucks, and it's just killing me.
Yeah, just your daughter.
Diego, thank you so
All of
much.
us.
Minister Puyo with us from
Inelastic.
Colombia as we talk about extractive minerals. These are some of the great challenges. We don't do this enough, Lisa. No question about it.
It's true because, frankly, when we talk about higher commodity prices, it goes into entire, how do you plan for an entire nation? I love the idea of coffee being much more inelastic when it comes to pricing than people thought.
I do want to point out that the minister's conversation dovetails perfectly from what we heard from Jeff Curry and Francisco Blanch, that this is supply coming on as being critical.
But how do you then capitalize as a country that produces coal at a time when there's so much distaste for that particular commodity?
I just got a text message. Is there enough money to buy the next marginal cup of Starbucks? We'll leave it there. Futures.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Yields are higher, the dollar is stronger, and equities are lower. From New York City this morning, good morning, good morning. Your equity market declining 37 points on the S&P. We're down 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, Treasury yields breaking out.
We've got a 10-year yield at 1.5%. I'm kind of questioning what took so long.
It's been a little overdue.
Decomposing what's moving the 10-year yield.
We seem to have a bit of clarity now on tapering.
A market really edging towards reflation.
There's been some unusual price action.
Powell has really spoon-fed the market.
That's obviously true in the bond market.
The steepening in the yield curve
makes a lot of sense.
They've telegraphed the tapering.
Do look for the 10-year yield to continue moving higher.
It's going to be an extended rise.
Rates should be moving higher.
It's just going to get tougher as we go forward.
Some days are going to be pretty uncomfortable.
Joining us now to discuss, Anna Han of Wells Fargo, Chris Maher of Ocean First, and Krishna Mamani of Lafayette College. Anna Han, straight to you. Is 154 a problem for this equity market?
I can't say it is, John. 154 yields are still so low, but finally they're moving in the right direction. And I think you're seeing that a little bit of that duration unwind yesterday. And like we've said, it's going to be a bit choppy markets, but it's a healthy kind of choppy and it's in the right direction. So I'm glad to see real yields finally peaking up. And I think that's going to help that cyclical trade. You're going to see a little weakness in growth, but I still think broadly speaking, equity markets are going to be higher end of this year.
Krishna, do you agree?
Well, so rates are certainly rising, that's for sure. The Fed is tapering, but expecting rates to continue to rise in an environment where U.S. growth, and for that matter, global growth, is going to be slowing down meaningfully over the next year. It's very difficult for me to see how rates go up much or significantly higher than where they are today.
You think this move could be self-limiting then, Krishna?
Absolutely. I think it's reaction and position unwind relative to the Fed taper talk. But what we have to worry about is really what is growth going to look like over the horizon, which is in 2022. And with the fiscal impulse in the U.S. slowing down and China purposefully slowing down its certain parts of its economy, it's very difficult for me to see how growth continues at its current pace and why rates would rise in that environment.
Chris, I would love your take on that, how self-limiting this sell-off could be in the bond market.
Well, John, good morning. Glad to be with you. First, it's a good sign this is happening. I think it's a healthy sign for the U.S. economy. In terms of being self-limiting, I think there will be an impact. I don't think you're going to see these rates just continue to move forward. But if you think about what's causing demand, very little of it is based on interest rates. So, we're not seeing the demand for housing change, the demand for cars, the demand for things in the economy changing much because of a movement in rates to this degree. So I don't think you're going to see a big change now, but I also don't think you're going to see a runaway situation.
Yield higher this morning by 5 basis points on 10s. Where are we? 153. North of 2% on 30s, yields higher on 2s by almost a basis point through 30 basis points. It's a big change from where we were a month ago. Digging into this is Kaylee Lines. Hey, Kaylee.
Indeed, it is a big change. Hey, John, we are looking at a 10-year yield that's at its highest since back in mid-June, but this sell-off isn't limited to treasuries. It's really a bond sell-off that has been global, led in many ways, actually, by gilts in the UK last week. The 10-year gilt yield is at its highest all the way since going all the way back to May 2019, looking at my screen here, 102 is where we sit, north of 1% for the first time in over a year. In Italy, the 10-year BTP yield now at 86 basis points. And in Germany, we're at negative just 19 basis points on the 10-year. But to bring the focus back to treasuries specifically, we were range-bound in the 130s on the 10-year for about a month prior to last week's Fed decision on Wednesday. We broke out to the 140s on Thursday, and then this morning, very quickly, we were holding north of 150, up 24 basis points in just 4 trading days. The velocity, that rate of change, is really what is notable here. And it's not just at the long end, John. We've seen movement in the belly and the short end as well. Of course, the 2-year yield, more controlled by the Fed. It is at its highest since March of last year, around 31 basis points. But with the long end moving up in a more pronounced way with higher growth and inflation expectations, it is leading to a steeper curve. The spread between 2 and 10 years, sitting at 122 basis points, which is the steepest it's been since June, as we look forward to a Fed that is likely to taper in November, John.
Katie, thank you. It's not steep, but it's steepening, and it's a big change. It's a 20 basis point change from where we were last Tuesday on a 10-year. The Fed chair had a role to play in this move. We'll hear from him a little bit later this morning. In some pre-prepared remarks released ahead of time, this is what we hear from the chairman in about 55 minutes. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could again prove to be greater and more enduring than anticipated, posing upside risk to inflation. Now, Chris, I want to come to you on this because you have a unique perspective on our panel. As you talk to clients, talk to companies, talk to corporates, are they set up for this world to continue through much of next year and perhaps even into 23?
Well, so
yeah, they're definitely preparing.
Chris Mao, you, sir.
I'm sorry. Sorry, there definitely, our clients are preparing for this situation to be protracted. So they're seeing the supply side issues. When you look at transportation issues, the bottlenecks in the ports, the availability of labor, it is going to take, based on the backlogs that they have built today, it's going to take them quite some time just to fill the backlogs in their orders, let alone rebuild inventories and get back to where they'd like to be. So our clients are telling us that this is a cycle it's going to take through the end of 22. In some cases, it may go well into 2023 before they are able to normalize their businesses. Normal backlogs, normal inventories, normal margins, those sorts of things.
Anna, we're going into earnings season, and this is a key concern, how long some of these issues will persist. What's the playbook for you guys over at Wells Fargo, together with Chris Harvey? Really bullish year-end call. What does earnings season look like for you?
It's a temperature check on the markets for us, on corporates, and see how these margins hold up in face of, like you're mentioning, supply chain kinks, issues with labor shortages. But that's a difference between the next 3 months and you guys were discussing 2022, 2023. But in the short term so far, corporates have generally been able to pass along those prices. They've been able to maintain those margins. And, it's not going to be every winner, every company doing great. It's going to be who leads out of this pack and who seems to sink a little bit. And I think for us, generally, we're still seeing people able to float those prices along, and that's what we're watching most carefully out of earnings.
We've discussed what Chairman Powell will be talking about at the top of the hour. He'll be alongside Secretary Yellen. Secretary Yellen saying the following in a letter to Congress on the debt limit. The U.S. is likely to hit that debt ceiling by October 18th. No doubt Secretary Yellen may well repeat that in about 53 minutes' time when we have that testimony a little bit later this morning. That coverage, of course, on TV, on radio here at Bloomberg. Krishna, to you, sir, I'd like your reaction to that headline, please. The U.S. likely to hit the debt ceiling by October 18th. Most people on this show have shrugged off this story. Are you doing the same thing?
Well, so if you go back and look at what has happened over the last decade on this topic and what really happens after the market reacts to a potential, I think it's very easy for me to shrug that off. The likelihood that anybody in their right mind would play with this particular topic on a sustained basis after the political positioning is done and over with, it's very difficult to see how that plays out.
We've seen the movie before, though, Krishna. Why would it end any differently?
Well, so precisely. I think we will talk a lot about it. We'll have a song and dance about how we are not going to do this, but eventually we will end up increasing the debt limit. So debt limit is just a drama for TV and political positioning. From economic perspective and from policy perspective, it really hasn't had any impact, and it's not going to have any impact.
I'm not trying to add any drama to it, Krishna, just to be clear. The US likely to hit the debt ceiling by October 18th, according to Secretary Yellen. We'll hear from Secretary Yellen and Chairman Powell a little bit later this morning. If you want some drama, look to the commodity market in this call from Bank of America. Francisco Blanche looking for triple-digit crude. Take a listen.
We have an underinvestment problem that we can't solve easily. And at the same time, we have surging demand because we keep printing all this money. And my concern is prices for oil and other commodities spike. And what are we going to do? Are we going to say this is transitionary and we're going to keep feeding more money and increasing our debts, our government debts to cure the problem? That's definitely not going to help our transitory inflation story.
Transitory for longer, maybe. With more, here's Abby.
John, well, it's really interesting here with this surge in the energy complex, the commodity complex. Is it reflation or inflation? Right now, it seems as though the market's taking it as reflation, but at $100 a barrel, if that happens, that would certainly be inflation. But as for the surge, take a look at this. Over the last month, you have Brent crude oil at about $80 per barrel, not so long ago, above $80 per barrel, up 6 days in a row, up 6 weeks in a row, the highest level since 2015. WTI up 10% over the last month, the highest level since November of 2014, and natural gas simply going bonkers at above $6 a level on the futures contract, 34% gain over the last month. So again, is it reflation or inflation? We'll see on the day. Actually, we have a little bit of a cooling off now in the natural gas space after yesterday's 13% gain and huge gains for a lot of those stocks, but nonetheless, big gains here. And there's reason to think it could keep going because there's some saying that this has to do with demand, which is so interesting because if you recall, just a couple of weeks ago on Delta, there were fears that the demand picture was going to fall apart. Now folks are saying demand is strong, but it also has to do with supply. Oil inventory is seen falling once again this week, already down 16 out of the last 18 weeks. If that continues, John, that supply-demand picture, it really could perhaps drive oil back up toward those incredible levels and already so high.
Abby, thank you. This is the line from Jeff Curry over at Goldman Sachs speaking to Francine Lacqua. It's the revenge of the old economy. He said poor returns saw capital redirected away from the old economy to the new economy. That is what is contributing to this big push higher in crude. Anahan, I want your view on the energy patch within the equity market. That particular sector has had a great run over the last 5 days. Is that something you're constructive on too?
Well, when we think about it, what we do like about this sector is it has that sort of cyclical exposure. It has had that COVID beta. But, you know, you bring up a great point with energy. It's always a push-pull argument. You have a demand side as that reopening continues, as we get into the winter months as well. But you also have something that's a little harder to predict, which is the supply side. So for us, not our favorite part of the market, but something that we're not particularly negative on either.
Chris, any energy clients of yours in the energy patch who are looking at investing at the moment off the back of these higher prices? Is that a factor for them?
Yeah, we're not overly concerned about that. I think when you look at the energy, especially the sector in the U.S., there's a lot of latent production capacity, tremendous amount. In fact, in the natural gas wells, you really just have to kind of turn on more production. So as with lumber, I think the cure for high prices in this environment is high prices, right? And they'll bring in more supply and you'll get prices down. So I don't think this is going to be a persistent threat. It may be out there for a little while, but it's a much easier fix than, say, chip supplies or specialty metals or those sorts of things.
Krishna, that's a big point, that the cure for high prices is high prices. Does that apply to a world for energy when we're shifting away from the old energy story to the new energy one? That's where the investment seems to be at the moment.
So I think if you think about it, if you are going to be a corporate fiduciary and you think about investing for the long term, and energy investment is always for the long term, the likelihood that you, because of these temporary higher prices, because of shortages and supply bottlenecks, that all of a sudden you'll start investing in a big way when the secular trend is still extraordinarily negative because of all sorts of political and social issues. I don't think that comes about. This is a temporary spike, and that's why we look through all of this through core PCE as opposed to with energy prices included.
Krishna Mamani sticking with us alongside Anna Hahn and Chris Ma. Coming up, the debt ceiling debate with Secretary Yellen delivering a big headline in the last 10 minutes. Put this date in your diary. It is the middle of October when Secretary Yellen thinks we will breach the debt limit. October 18th. That conversation next. This is Bloomberg.
China, if you look at U.S. taxes, how much time do you spend figuring out these big overarching themes as opposed to what happens with inflation?
There's an awful lot going on at the moment, as you say, and clearly some of the big debates at the moment are the slowing global growth picture, which we're seeing everywhere. And we're also seeing that at a time when inflation is rising and is proving pretty sticky. And to your earlier points, Francine, essentially the interplay between those two is critical. So some of those news events this week, whether it's OPEC and what's happening from a supply perspective, is going to be crucial, or indeed, of course, that US CPI print. So we've spent a lot of time thinking about inflation more recently, because clearly that leads into when we feel you may start to see the taper and when you might start to see rates going back up, particularly in the US. I mean, what might be useful just to explain a little bit is the focus that we've seen from everybody on China. You know, clearly China, huge in terms of the global commodity cycle.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I want to make sure everyone understands exactly what has happened here on the Senate floor. The Republican Party has now become the party of default. Republicans would let the country default for the first time in history. It's one of the most reckless, one of the most irresponsible votes I have seen taken place in the Senate.
Republicans ramping up the pressure, forcing Democrats to act quickly after blocking a bill to suspend the debt ceiling. Secretary Yellen urging congressional leaders to move quickly, writing in a letter, "We now estimate that the Treasury is likely to exhaust its extraordinary measures if Congress has not acted to raise or suspend the debt limit by October 18th. Let's bring in Bloomberg's Anne-Marie for more down in D.C. Morning, Anne-Marie.
Good morning, John. Yeah, this letter from Treasury Secretary Janet Yellen is just showing how quickly Congress needs to move to make sure they avert a technical default. She's saying that X date we've been talking about sometime in the middle of October to November is actually October 18th. Now, what is so tricky is that we had the Senate yesterday, the Republicans shut down a measure that would have suspended the debt limit. This was also going to help avert a potential shutdown of the government starting Friday at 12:01 a.m. But when it comes to the debt ceiling, the Republicans don't want a technical default, but they don't want to be the ones that have to vote for it. They want the Democrats to do this alone. And Jonathan, this is where things can get very cumbersome for the Democrats. They would have to go back to that budget resolution, that framework that they were working on in part for the $3.5 trillion reconciliation. Past that framework, they could do this with separate legislation, but it has to go through the reconciliation process, which means at least 2 Senate debates, potentially vote-a-ramas, and then back to the House. That would be at least 2 weeks. So even if they were to start today, to get to October 18th, that just gives them 6 days of wiggle room, Jonathan. So you can see the pressure is really mounting here on the Hill.
Anne-Marie, in about 42 minutes' time, we'll hear from Secretary Yellen and Chairman Powell. What are you expecting to hear?
I expect them to really toe the line of the same message we've heard from, especially from Chairman Powell in terms of inflation, and I believe Secretary Yellen will do the same. But potentially Secretary Yellen, because she is now, Jonathan, in a political position, she could bring this message home in person. She can talk about the fact that we should, one, avoid a government shutdown starting on Friday at 12:01. To do that, Congress would need to act this week with a stopgap funding measure. And then two, she will likely reiterate what we just heard from this congressional letter she sent to leadership about that October 18th deadline when it comes to the debt ceiling.
That testimony coming up in about 42 minutes' time. Anne-Marie Hordern, our Washington correspondent down in D.C. Anne-Marie, thank you. I repeat that letter to congressional leaders from the Treasury Secretary. We now estimate that the Treasury is likely to exhaust its extraordinary measures if Congress has not acted to raise or suspend the debt limit by October 18th. Krishna, we touched on this briefly. Krishna, you've made the point repeatedly through much of this year. There's too much attention on the Fed and not enough on the fiscal story, which is likely to fade through next year. Do you still stand by that?
Absolutely. I think, if anything, the debt ceiling debate kind of highlights what the fight is really about. It's really about fiscal spending far more than anything else. Nobody wants to keep or bring down the U.S. economy by quibbling about the debt ceiling limit that has no meaning whatsoever. So the fiscal impulse is going to slow down. It's already in the works. And that is the case even if we pass infrastructure and the $3.5 trillion budget initiative of the Biden administration. So from that standpoint, that's already cooked. Things are going to be a lot slower in 2022, and there's nothing anybody can do in the interim to kind of get away from that. The problem we have right now is the Fed is in a tough spot, and because of inflationary pressures, it's basically getting forced into doing things that it perhaps doesn't want to do and perhaps shouldn't do at this point.
Anna Hahn, I'd love your take on this as well. At the start of the year, we had this big cyclical trade, and a fiscal story down in Washington was a bullish factor for that. What is it now?
Well, nothing, good lasts forever. So we knew that kind of fiscal energy was going to putter out eventually, or at least get decreased. But, I agree the debt ceiling here is another pawn on the chessboard for these two sides duking it out in politics. Right now, you look at the derivatives market, not so much concern priced in there, but also combined with this debt ceiling concern, you have other factors like a government shutdown, like what's going to happen when earnings season comes around and the focus goes on micro and on supply chain. So put all together, I think right now the equity market has its attention elsewhere, and really the impact or the potential for an adverse impact from a debt ceiling not being lifted, the government shutdown, is still quite small for us.
Allow me to share the line from George Goncalves of MUFG. This is what he had to say. For those shaking their heads at the prospects of another avoidable risk of running up to or worse through the debt ceiling, we commiserate. Yet here we are again. There is an unhealthy level of complacency on both parts of the markets and DC policymakers. Chris Marr, can I have your response to that? Do you think there is an unhealthy level of complacency for markets and for policymakers alike?
Oh, absolutely, John. I want to go back to your thoughts about the fourth quarter and then tie them back to Krishna and Anna.
Sure.
I think they both make great points. Fiscal stimulus is going to be abating over the course of the next 6 months, even if we pass infrastructure. So the games that are being played now in Washington are putting that, even what's already a headwind, making it a steeper headwind potentially. And I'm concerned about the fourth quarter, not from a demand perspective, but from a supply perspective. When I talk to my clients, they tell me they've got the orders, they've got the demand, they're having trouble meeting that demand. They simply can't get the materials and the parts and the things shipped to the places they need them. So I think you may see a weaker performance in the fourth quarter than many realize, especially in the industrial sectors, manufacturing sectors, the folks that are most impacted by both the supply chain and labor. And we just don't need Washington adding more drama to that mix.
Chris, I really value your insight on this because you have a unique insight into what's happening with corporations in America. Can price buy that supply, or is this not a price issue?
It's not a price issue. Pricing is turned out to be a lever that's not working lately, right? When you have, I think it's 60, 70 ships off the coast of Los Angeles, we have 25 containers, 30 containers off the coast of New York. You simply can't get the goods where they need to go. And, increasingly, price is not the negotiating point. The negotiating point is around availability and certainty and Our clients are resorting to, paying what they need to pay, but trying to get through, manufacturer allotments. It's very common now if you need resins or, basic materials, no matter what you order, you're getting allocated. And that's a very hard thing if you're a manufacturing company.
How much of that story is going to show up in earnings season? That's a big focus for us. Chris, I appreciate that line, sir. As always, I appreciate you. Chris Marr there of Ocean First, alongside Anna Hahn and Krishna Mamani. Coming up on the programme, the morning calls, and later, the latest spike in Treasury yields quickly becoming a problem for richly valued tech stocks. It's the outperformance on the small caps that gets your attention in the past 24 hours. It gets ours too. That's next. This is Bloomberg.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Bond yields at the epicenter of what's happening here. Once again, relative outperformance on the small caps. The Russell down just 0.4, the Nasdaq down by 1.35%. A story to keep an eye on going into the opening bell. That's the price action. Let's get you some morning calls. First up, Barclays upgrading SiriusXM to equal weight. The analyst praising the management's recent execution and the stock's attractive risk-reward profile. Morgan Stanley downgrading Wells Fargo to equal weight. The analyst now expecting the Fed's asset cap to remain in place an extra year, skewing risk to the downside. And finally, Berenberg downgrading Morgan Stanley to a hold. The analyst warning that shares are now fully valued after rallying 55% since the start of the year. There are three of your calls. Up next, tech futures extending their declines. Your opening bell just around the corner. From New York, this is Bloomberg.
didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams. There are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Not looking good for the equity bulls going into the opening bell. From New York City this morning, good morning. This Tuesday morning, we decline. We're negative 31 on the S&P. We're down about 0.7%. Underperformance on the NASDAQ, down by 1.3%. Relative outperformance on a small caps, the Russell, down just a third. There's the opening bell. Switch on the board and get to the bond market. At the epicenter of this move is this one right here. Yields up 5 basis points on 10s to 154. We'll talk about this move in the bond market in just a moment. In the FX market, the dollar showing some strength, the euro some weakness. Euro dollar comfortably below 117 at 116.84, down 0.1%. And the crude rally continues, 76.27 on WTI. We're positive there by more than 1%. That's the cross-asset price action this Tuesday at the market desk with your movers. Here's Abby.
John, well, the tech weakness really stands out. The NASDAQ 100 down in a big way for a second day, having everything to do with rates rising, calling into question valuation on those growth stocks. Clearly, tech stocks not liking 150 on the way back up. That was similar to what we saw in March. You can see Apple, Microsoft, Amazon all down sharply, about $6 trillion worth of market cap there, helping to explain why you have the S&P 500 down 0.6% and the NASDAQ 100 down 1.2%. What is helping out the S&P 500 in particular, but also from a theme perspective, the Russell 2000. Take a look at the reflation trade on yields higher. You do have some of the big banks higher. That's true too for the regional banks, Bank of America and Citigroup, both up more than 0.5%. And ExxonMobil and Occidental Petroleum, even though oil is off of the day's highs, it is still in this big uptrend over the last month, really helping out big oil. So inflation for tech, reflation for the cyclical sectors.
6-day winning streak for energy equities. Abby, thank you for that. 6-day winning streak. And over the 6 days, we're up by 13 percentage points. Abby gave it a picture of this market. Let me repeat it. The broader market is down about 0.6%. The heavy weighting of tech dragging us down here. That sector is off by 1 full percentage point and some. Energy top of the pile. Outperformance there up a little more than 1%. The relationship between this bond market and this equity market has been really quite inconsistent through the year and very choppy. To weigh in on that, here's Katie Greifeld. Hey, Katie.
Hey, John. Well, the relationship has been inconsistent, but right now it is a textbook rotation trade. If you look at rates rising, banks are rising too, and that's the case this morning with the 10-year yield touching 1.54%. That spurred a rally in the KBW Bank Index, as you can see, up nearly 10%. Bank of America and JP Morgan, too, opening higher. Both of those banks are at just about a record high, John. And of course, that's great news for the value trade, given that financials are one of the biggest sectors in value indexes. If you look over the past 2 months, obviously growth stocks have led the way, tech in particular, but that's changing now. You can see that value has actually caught up and surpassed growth. And of course, this big rally in value has come at tech's expense, which of course is dragging down stock benchmarks overall, and that's bad news for the 60-40 portfolio. Trying to hedge your stocks with bonds, the standard 60-40 portfolio has lost nearly 2% so far this month, putting it on track for the worst month in a year, John.
Add today to that list as well. Katie, thank you. Katie Greifeld on this market. The relationship between bonds and equities. Here's Mark Haefele over at UBS. He says the following: modestly higher rates look likely to impact relative sector performance instead of dampening the equity rally overall. For some reaction, Anna Hahn and Krishna Mamani. Anna, your response to that, do you agree?
I would agree with that, John. Again, rates are still at a very, very low level, but I think something to appreciate here as well is the velocity at which rates move. When you see this sort of surge, it's going to jolt the markets versus something more orderly. Now, again, we're coming off very low levels, but if a breakneck pace keeps up, which I don't think is quite likely, if you see that sort of accelerate or rates and yields just take off, that could spook the markets and have an overall adverse impact. But for now, I think the kind of action you're seeing, rotation, and we've seen it before.
Does it have legs this time around, Anna? It stalled out in March of this year. At the end of March, small caps had topped, yields had topped. Why is this any different?
Well, I think this time, and we've got a little more under control. We had some variant concerns, but look, for the next 3 months, we think the broader trend is going to continue here, that yields have just really been, especially real yields, just way too low. Almost didn't make sense to us. And now that you're seeing somewhat normalized and moving in the right direction, I think you're going to be able to see that somewhat consistency, or at least continue over the next 3 months. But, you know, like we were discussing before, it's a little different ballgame when you think about 18 months or 24 months down the line.
Krishna, add to that, how durable would any rotation be if we do have a similar story to what we saw in spring?
Well, that's really a very interesting question, because I think what we are trying to do is fit a fundamental framework into momentum trading markets.
Yeah.
And that will always get you to the wrong answer. Right now, rates are rising, and in the current environment, they will probably continue to rise because of momentum players piling on, and that probably is the case. But at some point, that gets exhausted, and we turn around. I think for you to make a peg on the rates, you have to think of economic growth a little further than the next quarter. You have to think of what the economic picture looks like in 2022 and 2023. And if you kind of use that framework, it's quite clear to me that rates may go up some, but eventually the likelihood that they'll go up a lot, and therefore cyclicals will rally in a big way over the next 24 months. I assign very low probability to that.
Krishna, that's the issue for a lot of people, that we take a single day's price action and start to extrapolate that out through the whole cycle. I get asking all this morning, what's changed in the last week? What's changed is 20 basis points on a 10-year yield. Prices shape narrative, and now we're thinking about the story on the screen as it plays out through the whole cycle. Krishna, you've been pretty consistent about this. You think the cycle winner is in tech because rates can only go so high. Is that the story you're pushing this morning?
Absolutely. I think for you to think in cycle terms, you have to think beyond next quarter or next 2 quarters. And if you go to 2022, end of 2022, early 23, the likelihood that cyclicals will do meaningfully better than tech is actually unfathomable for me. The point that we ought to be debating is the market's going to be a whole lot higher if this slowdown trend continues, along with the Fed tightening policy. I think that's a combustible mixture for 2022. Cyclicals, tech may do much better than cyclicals, but we may do far worse overall.
Anna, I think it's interesting to look at your call for next year too, because you sound really bullish right now into year end, but compared to your year end target for this year to next year, you're not. What's the difference between how we're set up going into year end and how you think we'll look going into year end next year?
Well, that's the difference between making a short-term call and a long-term call, John. You know, if you're worried about what's going to happen in 2023 and you position today for it, I think there's opportunities that you're going to miss out. Now, of course, set a time where you're going to have this quarter versus the next several quarters. But that's the difference between our call for this year being bullish, like you mentioned, and next year looking for that multiple contraction. But if you sit here and decide that you're not going to do anything, or you're going to take that very defensive or just a growth outlook for, you know, an 18-month play, I still think there's opportunity this quarter. So that's why we're still long the cyclicals. We have a little bit of low vol exposure, but come next year, I do suspect that we're going to be ramping up on the defensive exposure. Expect that multiple compression as the global growth slows down, U.S. growth slows down, and we see sort of more of that accommodation being peeled away from us. So I think it's two different kind of frameworks, and keeping both in mind, I think you can play both.
And to be clear here, you are in two different seats. Krishna, you have a different mandate now. If I was to ask you, though, where in this equity market you would be comfortable sitting into year end, would it be the same answer to the question I asked about the cycle?
Yes, I think eventually the rise in rates will peter out before year end. And therefore, I still think tech overall will probably deliver better relative returns rather than cyclicals. I feel pretty confident about that.
Krishna, do you remember Evergrande in China? It's only a week ago. No one's discussing it anymore, Krishna. We haven't even settled the issue. Why is that, Krishna?
Well, so this is a policy-driven market, and people who are looking for Lehman moment focus on, wrongly, focus on things like Evergrande. But at the end of the day, what happens in the U.S. equity markets, and for that matter, global equity market, is fiscal policy globally and monetary policy. All of that is reasonably supportive at the moment, so we can look through Evergrande. But when that turns in 2022, as people are asking the Fed to do, and fiscal policy is slowing down, that is what we need to worry about, rather than focus on the debate whether cyclicals or tech are going to do better near term.
Krishna, thanks for that, sir. As always, Krishna Mamani there, and to Anna Han, thank you to you both. About 9-10 minutes into the session, equities declined by 0.8%. The Nasdaq Composite down by 1.4%. It's some relative outperformance on a small caps. Let's get you some movers. Here's Abby.
John, there is a fair amount of pain out there for stocks, especially those tech stocks that we'll be taking a look at in a moment. But what is working? Energy, the top sector on the day, one of a very few handful of sectors that are working on the day, up more than 1%. Some of the big energy names are climbing higher, including ExxonMobil and ConocoPhillips. As oil, as you know, up for a 6-day and a 6-week in a row at its highest level since 2014. But we also just had a breaking headline around cotton at its highest level since 2011, rising above $1 a pound. On this, we have a cotton ETF and an ag ETF, both higher. The likes of Ralph Lauren and Hanesbrands also higher on this, although interestingly, it could spell inflation over the long term for jeans. Now, taking a look at banks and really rates, the driver, of course, as you know, of all this action, helping out the banks, the big banks, but there is that tech pain. Apple and Microsoft down in a big way, more than $4 trillion worth of market cap there. That helps to explain why we have stocks down for a second day in a row, John.
Abby, thank you. Thank you very much. The move on the long bond this morning, unreal, up by 9 basis points, pushing 2.1% on 10s, up 6, pushing 155 now, pushing 31 basis points on 2s, up there by almost a basis point. Look out for supply a little bit later. $62 billion of 7-year notes coming up at about 1 p.m. Eastern time. Coming up at 10 a.m. Eastern time, investors counting down to Senate testimony from Fed Chair Jay Powell and Treasury Secretary Janet Yellen. That conversation coming up from New York. This is Bloomberg.
you went to Harvard Law School, did you say, maybe someday I'll be on the Supreme Court?
Anybody who thinks maybe someday I'll be on the Supreme Court, I don't want to say there's something wrong with him, but there is something wrong.
There is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
Watch Bloomberg Surveillance to stay on top of the latest market trends, commodity trends, and fashion trends.
Are you going out for a fitting on a base suit?
I'm going to go and get a base suit. The crowdfund was very profitable.
$100,000.
Came in at about 100K, which is what it would take for me to wear that suit on this network. How do you get that bulky fit? I'll find out. I'll have a chat.
You get bulky,
I get the
John.
bulky one.
You know, I'm channeling the president.
Look at those markets.
Don't taper the pants.
John,
Equity
you
futures
look
down
so
6.
good in a base suit.
We're dead on the
dreaming.
S&P.
I think it's clear that we made substantial further progress in achieving our inflation goal. There's also been very good progress towards maximum employment. Now, assuming the economy continues to improve as I anticipate, a moderation in the pace of asset purchases may soon be warranted.
Fed officials reinforcing taper signals with the central bank losing 2 members ahead of Chairman Powell's testimony. The departures easing pressure perhaps on the chairman as he heads to Capitol Hill alongside Secretary Yellen. For more, let's bring in Bloomberg economics editor Mike McKee. Mike, we'll get to the Chairman Powell story in just a moment. I'm not sure how much heat that actually takes off him. Let's start with Secretary Yellen. We have a date.
We have a date, and she is warning that the U.S. could be in trouble by October 18th. Now, nobody will be shocked that politics is played up on Capitol Hill, and this hearing is going to be all about politics, not really about the pandemic rescue programs that it is ostensibly supposed to be about. But this is Janet Yellen's latest letter to Congress notifying them that they expect October 18th is the drop-dead date. At that point, we expect Treasury would be left with very limited resources that would be depleted quickly. It is uncertain whether we could continue to meet all the nation's commitments after that date. So then the question becomes from the panel, what are you going to do about it? Remember, back in 2011, 2013, the Fed and the Treasury discussed options for how to handle this. Jay Powell told me last week that he doesn't want to comment on those options, but he may not have a choice today. Powell actually going to be talking about the economy, and as you mentioned at the top of the show, he's going to be warning about inflation again. The Fed is a little concerned that inflation has lasted longer and been higher than it was. As the economy continues to reopen, he says, and spending rebounds, we're seeing upward pressure on prices, particularly due to supply bottlenecks in some sectors. These effects have been larger and longer lasting than anticipated, but they will abate. He's sticking to the same hymn book. As they do, inflation is expected to drop back toward our longer run 2% goal. You mentioned the pressure on Jay Powell. There are going to be other issues besides the drop-dead date and the Fed and inflation. They're going to be talking, no doubt, about the ethics issues at the Fed, the resignations of Eric Rosengren and Rob Kaplan. That'll be one of the issues before them today. Bank regulation. Elizabeth Warren is on this committee, and she's been very hot on the idea of breaking up Wells Fargo. So Janet Yellen may get some questions on that, as might Jay Powell. And then the shutdown and the Biden plans. Last night, Republicans voted against a vote on the debt ceiling and the shutdown. Do they separate? She's much more of an academic, so it'll be interesting to see how she tries to phrase this in a way that would scare Congress. Basically, you're right. They've already spent the money that would be under the debt ceiling, and so it's not a question of what Biden wants to spend, it's what they've already spent. The October 18th date, she's been slow to put a date on it, probably because she figures Congress would wait until the absolute last minute, but now we have a date because they probably have to separate out the debt ceiling, put it into reconciliation. That'll take time, and she's got to light a fire under both Democrats and Republicans.
Let's finish on the fire that could be under Chairman Powell a little bit later this morning. Mike, some people have framed this as these resignations take the heat off the chairman today. I wonder from your perspective whether you actually think it keeps the spotlight on him. Those two have gone now. That's dealt with. What about him?
It keeps the spotlight on him a little bit, but it does suggest that he lived up to his pledge last week to take effective action and make sure this doesn't happen again. He cleaned house, or at least it appears that way, even if he didn't personally order them to resign. So in that sense, it takes some pressure off him. It'll obviously be an issue, but with Kaplan and Rosengren gone, that should fade.
Composition is going to be the story for next year now, Mike. I'd love your thoughts on this. It's starting to become a much bigger conversation into next year. There's a few empty seats now on the Federal Reserve.
Yeah, but remember, these are seats for cities rather than individuals, and it'll be up to the boards of directors to choose people. So there's been a knee-jerk reaction that Kaplan and Rosengren were hawks, and so therefore we might get more dovish, but they could pick hawks to replace them as well. So we're going to have to wait and see who sits in the seat. In the meantime, the only real effect, since neither were voters this year, would be on the dot plot, the next dot plot in December, and it is likely that the first vice presidents who are filling in will just keep the same view as Kaplan and
Mike, do you think the Federal Reserve Board will try and have a lot of input, try and shape the decisions from the Dallas Fed and the Boston Fed about who comes next?
I'm sure they will. The Fed has the right of rejection. They can reject any nominee from the boards of directors of these regional banks, and so they will use that power probably to make sure that there is a vigorous search, that it is includes a lot of minorities, and that the Fed looks good in the process of getting somebody.
A measured Mike McKee ahead of testimony from Chairman Powell and Secretary Yellen coming up a little bit later this morning. 10 a.m. Eastern time. They've both got their own issues. Senator Manchin, according to a report right now, will head to the White House for a meeting with President Biden today. Those two have some talking to do. This package, how big will it be? I've heard it at 3.5. I heard some twos. I heard some ones. Heard a lot more about the ones, maybe 1.5 trillion as well. Senator Manchin could be the man that decides what number is in front of that package a little bit later at some point this year, if we do indeed pass it. For this equity market, we are lower. For this bond market, 30-year yields are up 10 basis points, pushing 2.1%. They're up on 10s. They're up on 2s, this whole curve with a lift. Let's get the sector price action. Here's Dave Wilson.
Thanks, John. You've got 10 of the 11 main industry groups in the S&P 500 lower at the moment. Financial stocks have just turned lower in the face of those higher Treasury yields. Energy stocks, the only ones that are higher. Utilities are notable because the S&P 500 Utilities Index is now down for the 14th straight day. And if that holds, it will extend the longest losing streak ever for that index since it was first calculated back in 1989. Now, technology stocks are faring the worst, whether you look at the group specifically or communication services, which includes Google's owner Alphabet, as well as Facebook. They're bringing that particular segment of the market down. And when you look at technology stocks, a big piece of what's going on there tied into semiconductors, whether we're talking the chip makers or the chip equipment makers. We had New Street Research turning neutral on the equipment group, cutting its rating on Applied Materials, as well as ASML Holding, based in the Netherlands, but part of the Philadelphia Semiconductor Index, the stocks, they're leading that particular indicator down. We also saw a rating cut on Microchip Technology out of Wells Fargo. Those shares are lower. In fact, all 30 stocks in the stocks are down, and this is a group that was not doing half bad just a few days ago, and it's pulling back here.
Mike, thank you. Dave Wilson, thank you, sir. Distracted by the bond market screen at the moment. What a move we've seen. It's not just about the level, it's about how quickly we've got there. From early August, from 112.58 on 10s, through 130, blasting through 140, 150. now at 156 and up 8 basis points on a session. That's 10s. Do the same thing on 5s, where the rate hike debate is playing out right now. Low 60s in early August. Right now, we are nicely through 1% and up 4 basis points on a session. It's that rate hike debate through the front end and the belly of the curve that's getting a lot of attention for good reason. Just how loose will any potential tightening be if we do start a tighter monetary policy over at this Federal Reserve? Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. Your equity market heading south. The S&P down by more than 1 full percentage point. We're negative 53. This is Bloomberg. City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics? How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
25 minutes in, it's a little bit messy. We're down by more than 1 percentage point on the S&P. Talked a lot about that relative outperformance on the small caps. It's all relative. We're still down 1% on the Russell. The Nasdaq off by 1.7. Get to the bond market. Yields higher. 30s, the long bond up 10 basis points to about 2.1%, and 10-year yields pushing 156. That's the price action. Here's the trading diary. What you need to be looking for through the next couple of days. Secretary Yellen, Fed Chair Powell, top of the hour, testifying in front of the Senate. The Treasury selling $62 billion in 7-year notes at 1 p.m. Eastern Time. Fed speak coming up a little bit later. Bowman, Bostic, Bullard later this afternoon into Thursday. Jobless claims coming up and GDP figures. And finally, rounding out the week with ISM manufacturing numbers on Friday. From New York, this was the countdown to the open. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, And we can do what we, developed world, need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Who are U.S. Open tennis champion Emma Raducanu's 3 dream dinner guests?
Daniel Ricciardo, Michael Jordan, and then Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah.
Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see 2 Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
So there's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings there.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry citizens?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and he was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all, suddenly
transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the U.S. alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then, this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends.
But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start. From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. election. Yes.
The U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.